For most of history, money was something you could hold: gold coins, silver pieces, metal with weight. A coin did not represent wealth, it was wealth. But today, almost all money exists as numbers inside financial systems. No metal. No physical backing, just digital balances moving between banks. So when did money stop being tied to something real? And what replaced the gold that once anchored the entire system? For centuries, money literally had weight. Gold and silver coins moved through markets, ports, and caravan routes. Merchants accepted them not because of promises, but because the metal itself had value. Gold was rare. Silver demanded labor and time to mine. Because metal was scarce, the money supply grew slowly. That limitation created stability. A coin held value because something tangible stood behind it. Money was not only a symbol, it was stored wealth. For generations, this link between money and metal shaped how people understood value. As long as metal remained scarce, the system appeared stable. As economies expanded, carrying heavy metal became difficult. Banks and governments issued paper notes. These notes were claims on gold. Under the gold standard, paper currency could be exchanged for a fixed amount of gold. A banknote was a promise that metal waited behind it. This promise anchored trust. Even while people used paper, the system depended on gold stored in reserves. The metal remained the foundation of the monetary system. For many years, this arrangement seemed stable. But the modern economy was expanding rapidly. Industrial production increased. Global trade widened. Governments managed larger financial systems. All this required more money to move through the economy. Yet the supply of gold did not grow as quickly. Gold still had to be mined from the earth, and mining was slow. As economic activity accelerated, the limits of metal-backed money became harder to ignore. The world economy was growing faster than the supply of gold, creating tension inside the monetary system. That tension raised a deeper question for the system itself. If money depended on limited metal, could it support a rapidly growing global economy? If the economy kept growing faster than gold, what would money eventually become? This channel explores how economic systems quietly shape history, power, and financial stability. Subscribe to follow the deeper patterns that explain how money and global systems evolve. By the late 19th and early 20th centuries, the global economy was accelerating. Factories produced goods at unprecedented scale. Railways connected distant regions. Steamships moved products across oceans. International trade expanded rapidly. Economic activity was moving faster than ever before. All of this required money to circulate smoothly through the system. Businesses needed capital to expand. Merchants needed currency to settle trade. Governments needed funds to manage growing societies. But under the gold standard, the supply of money remained tied to something much slower. Gold still had to be mined from the earth. Even as economic activity accelerated, the supply of metal increased only gradually. This created a growing imbalance. The modern economy was expanding quickly, yet the monetary system still depended on a resource that grew slowly. For a time, the system continued functioning. But the tension between rapid economic growth and limited gold supply kept building. The strain on the gold system became especially visible during periods of crisis. Wars demanded enormous government spending. Armies had to be equipped, factories had to produce weapons, entire national economies were mobilized. These sudden demands required far more money than governments normally held in gold reserves. During wartime, governments often issued large amounts of paper currency to finance urgent costs. Strict gold backing became difficult to maintain. Crises revealed a fundamental weakness in the system. When governments needed money quickly, gold reserves could become a constraint. At the same time, modern financial systems were evolving. banks began creating credit to support investment and industrial growth. Loans financed railways, factories, and expanding businesses. Through banking systems, money could be created as credit rather than mined as metal. This allowed the economy to grow more rapidly. But it also meant the amount of money circulating in the economy increasingly depended on banks and financial policy. The link between money and physical gold was gradually loosening. The monetary system was slowly evolving beyond its metal foundation. As this transformation unfolded, the system began relying on something less tangible than metal: confidence. People accepted paper currency not because they expected to exchange it for gold every day, but because they trusted the institutions behind it. Governments managed currency, banks regulated credit, financial systems maintained stability. Gold still existed in theory, but the system was already learning to function through policy, institutions, and shared belief. Money was becoming less about metal and more about trust in the system itself. If the system was already learning to operate beyond gold, what happened when that final link to metal finally disappeared? By the middle of the 20th century, the global monetary system was again under pressure. Economic growth was accelerating. International trade was expanding. Financial systems were becoming larger and more complex. Yet the world's monetary structure still depended on gold. Under the international system established after the Second World War, many currencies were linked indirectly to gold through the United States dollar. The dollar itself remained convertible into gold at a fixed price. For a time, this arrangement appeared stable, but the same structural tension from earlier gold systems began to return. Global economic activity expanded rapidly. More dollars circulated across the world economy, but the gold reserves supporting those dollars grew much more slowly. The imbalance became increasingly difficult to ignore. As global demand for dollars rose, confidence in the system began to weaken. The world economy was once again expanding faster than the gold that anchored its money. As pressure increased, maintaining gold convertibility became harder. Foreign governments accumulated large amounts of dollars through trade and international finance. In theory, those dollars could still be exchanged for gold. In practice, the available gold reserves could not support unlimited conversion. The imbalance had reached a breaking point. Eventually, the link between the dollar and gold was suspended. For the first time in modern history, major global currencies were no longer directly convertible into precious metal. The monetary system crossed a historic threshold. Money was no longer defined by a fixed quantity of gold. The old foundation of the system had disappeared. This shift changed the nature of money itself. Currencies no longer represented claims on a physical resource. Instead, they became part of a managed economic system. Central banks began regulating the supply of money. Governments shaped economic policy. Financial institutions managed credit and investment. The value of currency increasingly depended on economic policy, institutional stability, and coordinated financial management. Money was no longer anchored to metal. It was anchored to the functioning of the system that issued it. In this new system, trust replaced metal as the foundation of money. Currency no longer derived its value from gold stored in vaults. Instead, people accepted money because they trusted the institutions managing it. Central banks monitored inflation. Governments guided economic policy. Financial systems coordinated lending, payments, and credit. Money had transformed from a physical claim on metal into a managed structure of policy and confidence. The nature of money had changed. What once depended on scarce metal now depended on trust in the system itself. If money was no longer anchored to gold, what now keeps modern currency valuable? When the link to gold finally ended, money entered a new phase. For centuries, gold had anchored the value of currency. Now that anchor was gone. Currencies no longer represented claims on a fixed quantity of metal, yet money itself did not disappear. Paper notes and bank balances continued circulating through the economy. People still used money to buy goods, pay wages, and settle debts, but the source of its value had changed. Instead of metal stored in vaults, the system now relied on institutions. Governments issued currency. Central banks managed the supply of money. Banks and financial systems supported lending and payments. Money still moved through daily transactions, but its foundation had shifted from physical metal to the stability of the system behind it. In this new structure, central banks became responsible for maintaining stability. Under the gold standard, money was limited by metal reserves. Now stability required active policy. Central banks adjusted interest rates. They monitored inflation. They influenced how easily credit could circulate through the economy. Through these tools, they guided the supply of money. This required constant management. Economic growth, financial crises, and changing markets all required adjustment. Money was no longer constrained by gold. Its stability now depended on policy decisions and institutional credibility. Modern money operates through coordination across many institutions. Governments manage fiscal policy. Central banks guide monetary policy. Commercial banks provide credit to businesses and households. Financial markets move capital across the global economy. Together, these institutions maintain the functioning of modern currency. Confidence in money now depends on the stability of this network. Millions of transactions occur every day because people trust that the system will continue working. Trust has replaced gold as the foundation of money. In this sense, money did not disappear when gold backing ended. Its nature changed. Earlier systems relied on scarce metal as the anchor of value. Modern systems rely on institutions, policy, and economic coordination. Currency no longer represents a fixed quantity of gold. Instead, it represents participation in a functioning financial system. Money became less about physical substance and more about organized trust. This channel explores how economic systems quietly shape money, power, and global stability. Subscribe to continue exploring the deeper forces that shape modern financial systems. Today, money still moves through every part of economic life. We earn it, spend it, and save it. Yet its value no longer comes from metal stored in vaults. It comes from confidence in the systems that manage it. Money stopped being tied to gold, but it did not stop working. Its foundation simply shifted from metal to trust.